Welcome to the Community Forum. My name is John Guglielmino, and I'm your host this evening. I've got a interesting program for you. We're going to be talking about the latest in mortgages with Jim Lahaney of Creative Mortgage here in town, and I think it'll be a very interesting program. I want to welcome you to the show, Jim.
Thank you, John. Pleasure to be here.
Yes. First of all, give us a little bit of your background as to how you got into mortgages in the first place. Your educational background, a little bit about your family, and then work your way up to that.
Well, from Danbury all my life, Danbury High School, Becker College for college work. Started selling after working at the Danbury Hospital a million years ago, and got into the mortgage business.
So you got into different types of sales?
I got into the mortgage business when I was like 42 years old, so I was not an early starter at all. But that's considering my age now, I've been in here a long time.
But that's where you accelerated, right?
Absolutely.
Okay. So you've gone through the environment of the previous years that we've had, several years of a downturn, so to speak, and seen quite a few changes in the industry. There's regulatory changes and the reduced price of real estate that's out there and all. How would you describe the market environment that's going on right now? Well, in general.
Okay, in a general term, the market is crazy a little bit. The first-time homebuyers are buying homes that are priced in areas what they can afford, not like what they were doing 5 years ago when everybody was overbuying stuff that was overpriced. Today, the low end of the market is working fine, and the high end of the market is moving along also. People are making some good incomes in some areas, and they want that beautiful home, and they're buying that beautiful home. So that's moving.
Is the government affecting the low end because the first-time home buyer program? Would you say that that's being helped by the government program?
Absolutely. Right. In that tax credit, the $8,000 tax credit, or the $6,500 if you're a second-time home buyer or such, is definitely working to boost the economy and get these people to buy now rather than waiting for 6 months or a year from now to buy. But it's also giving them the ability to buy realistically priced homes, something they can have and own 10 years from now if they still want to, not to face any difficulties that they would have 5 years ago.
How's the second one? Because that hasn't been out as long as that first one. The first-time home buyer's been out for a while, whereas I think there's still people out there they're not 100% sure about how that second program works.
The second program, if you're not a first-time home buyer, you're selling your home and you can get a $6,500 credit, tax credit, depending on your income naturally, and all these things will vary all over the place. So it's still out there. They're expecting it to expire in June. Some people are anticipating it's going to be extended, like everything else has been extended. But due to some of the trends that are out there, I'll wait till they actually announce it. I'm not going to call that one ahead of time for sure.
So would you say we've hit the bottom on this cycle, this recession? Some people call it mini depression, but I guess they call it the Great Recession.
Well, I'd like to hope we hit the bottom and it's going to be up and at 'em for everybody.
Right. So activity.
More jobs for everybody. More people that have been out of work for a long period of time finding gainful employment. Some of the government reports I'm not happy with, but that's government reports.
Right.
So I don't expect to be happy with them.
But the activity is up.
The activity is there. It's definitely moving in a general upward trend. Today was a fantastic day for me, just because of being out there calling on realtors, seeing other people I haven't seen in a while, and it came back to me fourfold today. So the market is definitely on an upward trend, I think.
Yeah. So there's a lot of questions about what's going on now. The banks have tightened up. There's activity, but you got to have 20% down, otherwise you can't get a mortgage. Aside from the programs, if you're a conventional mortgage purchaser, then you got to have 20%. Could you maybe pierce a few pins in that balloon there?
Oh, sure. Well, even the conventional mortgages have changed a lot. The more conservative lender wants to see the 20%, and that's the local banks. Naturally, those are the hometown operations. The lenders that are out there looking for money, looking to bring in new business, they're doing 5 and 10% down with good credit and with good ratios. You've got to be able to afford what you're buying. None of this buying blue sky. Then to even make it easier for a lot of people, the government has their FHA programs as well as their VA program that are both out there that we do. And on a VA loan, if you're a veteran, a qualified veteran, 0 down. 0 down, which is a very nice
But they are investigating that there actually is money there. You know, it's not like...
the money is there. The money is there. Yeah. There are investors putting out the money, and by investors I mean the big banks. The FHA mortgages, as they call them, those are FHA insured mortgages. The money still has to come from the investor market.
Right.
So that's probably where 70% of the business is today. And we do an FHA loan from a small one in the $100,000 range to a $650,000+. So it's not limited to just first-time home buyers.
But what I was getting is several years ago, they would sort of blink, wink at you and say, yeah, we could put down that you're doing this and blah, blah. None of that stuff. You actually have to be making $50,000 or $75,000 and a combined income $100,000 or $80,000, whatever it may be, to get a certain level of real estate.
And thank God, John, because that's what the blue sky buying, the buying 10 times your earnings, never should have happened. It did happen. It happened in collusion with the major lenders that were providing it. They saw the money and they said, look, we can make all that money, so let's do this. It was just no one person was at fault. It was the whole
thing went down at the same time.
The whole industry.
Yeah.
And it just grew out of proportion. It was like a bad virus.
And the AIG situation, facilitating stamping the paper as AAA when they were selling it, because you have to recycle. That's what people don't understand. If they weren't selling that mortgage paper off, then it would have all stopped. They wouldn't have gone around in a circle, and accelerated the way it did, because
That's correct.
They were recycling the loans.
And AIG was just one of the prime targets of the whole thing, offenders, if you want to call it that. These quasi-government organizations, Fannie and Freddie, they got their hands dirty too.
That's why they got in trouble.
Yeah, well, this is it.
Yeah.
They all got caught up in saying, "Look at the quick money. Look at the quick money." No, guys.
Yeah, and then when they were selling it off, even the bigger banks
sooner or later,
got involved.
People tightened up, and everything. There's no market for this. There's no market for that. Oh. Why not? We got a whole carload of it. And they had to do something, and everything.
So along with this program money, they do have to check out, hey, a combined income of $80,000 is actually here. You have jobs, and you're going for this level. Of course, you could get a starter home, and the prices have reduced for a lesser amount. There are. I know, I've heard up in New Milford there's homes for under $100,000. Yes, they're fixer-uppers, and there's money for those things, right? You're saying the bottom of the market, and then there's
yes. As a matter of fact, there's even money for the home. Some people say, well, there's a house over there, but it's a handyman special, and I don't have the $20,000 or $30,000 to fix it up, so therefore I can't buy it. Not true. Government has programs called a 203K Streamline, which allows them to get approximately $35,000 to do the fixing up, replacing the appliances, replacing the piping, doing the roof, whatever has to be done within that limitation. And if you need something bigger and it's worthwhile, then you can go into a full-fledged 203K, which is a rehab loan, which would even mean putting on an addition type of thing, which could have meant to hundreds of thousands of dollars. So there are programs out there, and we offer them all. And there's other companies that do it too. But the idea is it's out there. Too many people think, oh, I have to have 20% down or I can't buy a house.
Yeah, that's the thing.
False.
That's what kills people trying. That well, we're going to wait till the thing comes to an end, and then we're going to, so... You envision somehow there's someone sitting on a racetrack with a gun, and everybody's going to get up on the line at some point in time, and it doesn't work that way.
But, John, the things go around. 27 years ago when I got in this business, the banks were saying, you have to put down 20%. I went with a mortgage company that said FHA, 3% down.
If you're qualified, right?
If you're qualified. By the way, they also had a very tight residual qualification, which was something like the VA these days. So it was not something, nobody walked into a deal and was given a house. You had to have the income, you had to have low debt. And that's one of the biggest problems. People turn around and say, well, I make $80,000 a year. But you owe $40,000.
Yeah, 30 or 40,000.
No, you can't do that, folks. Sorry about that.
Yeah.
But this is where I probably spend most of my time talking to people that are thinking about buying something. The realtors say, hey, go see Jim. What's Jim going to do for me? He's going to tell us whether you can afford what you really think you can buy. I mean, it's an education process.
Right.
It really is an education process. And if the buyer is educated and knows what they're doing, really knows, and we have the facts and figures in front of them, it's a piece of cake, the acquiring of a home.
But with the real estate prices, since they've gone down quite a bit, there's, as I started saying before, there's houses for under $100,000 in the New Milford area, and I'm sure that what used to be $400,000 in Danbury, houses at $400,000 may be closer to $300,000. So there's a lot of opportunities out there.
Absolutely.
If you are not waiting at the starting gate, thinking, okay, maybe next year is when I go out, and maybe 300 other people are going to do the same thing, and that'll drive the price up right away, as opposed to getting in when things are gradually starting to go up.
This being correct, this being a low end of the market as it sits right now. Is it the bottom? I don't know. It could drop down a little bit and then go back up again. I mean, this is a seesaw. The whole
but there is
finance market is like that.
There's a bottoming price process going on here.
The same home you would buy last year, or excuse me, 5 years ago for $450,000 is probably $250,000 to $375,000 right now. Not a bad situation. You buy it now, and the way I look at it, over in my experience of these years, in the next 5 years or so, the market's going to come back. Not a tremendous amount. It's not going to come back like it was, but it's definitely going to improve and give you appreciation in the next 5 years. So you need a place to live anyways.
And
you might as well own it.
And you got the tax write-off.
And you got the tax write-off. Only if you move quickly. Right at this particular time, because of the limitations that the government has.
That's true. So yeah, we covered that, the fact that it might be choppy, but over the a 5-year period, you should be fine. Any recent examples, without obviously mentioning any clients' names, as to the type of people that you're seeing, maybe that like give an income and that this is the house, approximate price of the house that they're looking for, and in a vague area. You can say north of here.
Today was one of those weird days, and we went to extremes. A couple trying to buy a house, a condo actually, in the $160,000 to $70,000 price range, and it was tight, but it was their first home. And I probably spent 3 hours with them. A couple hours before that, a gentleman and his wife were talking to me about their property that they're buying at $1.2 million to $1.5 million, depending on how much they can get the price knocked down at. And I'm saying, what an extreme. I got the little end and I got the super high. Right. But that's the way the market is today. You don't know what you're going to get from 1 minute to the next. So when the phone rings and someone says, hello, bingo, you're on, and are they going to turn around and say, hey, I want to do something that is FHA, something that's affordable, something that's low cost, or we want our dream home, and we're financially able to afford the dream home. These are not people that are first-time home buyers on that high-priced house. They've owned a home for 5 and 6 and 7 years, and they've saved, and they have the money put away. So they can easily afford to do it if they wish, and if that's the proper decision for them to do at this time.
Yeah. So if you're in that position, you got income, and you got some. This is the time, because the
market is good.
Prices are not going to hell in a handbasket. Still, we are in a bottoming process. Yeah, you might have some dips, but you're pretty much at the bottom.
Right.
Okay. Now there's a product that was out years ago that has been rehabbed, so to speak, by the government with new regulations, and that is, I'm referring to reverse mortgages. They've been reintroduced with government regulations to control some of the activities that were going on with them when they first came out, and they've been made much better, I believe. What is a reverse mortgage? Is it something like reversing a car, it backs over you eventually, or no?
No, let's hope not. A reverse mortgage is basically only qualified for someone over age 62. In my mind, it's not for everyone. It's going to have a different purpose and a different effect on everyone that does it. Recently, people have had no mortgage, and one person outlived her annuity. I just lost $700 a month, and she has a $500,000 to $600,000 house that will probably appraise in the high fours. Or low fours even. Well, that's still quite a bit of funds, and she could take that as a annuity. I probably shouldn't use that word, but as a mortgage, where the bank is going to be paying her that much money over her life that she cannot outlive.
It goes according to age. So if somebody,
according to age,
if someone is like 80 years old, they could take 70% approximately.
Yeah, ballpark figure
of the value, and essentially never pay it back.
No. By the way, the difference between a regular mortgage and a reverse mortgage. A regular mortgage and a reverse mortgage, you have to pay your taxes. You have to pay your insurance. You have to pay for your maintenance. That happens no matter what kind of mortgage you have.
Right.
A regular mortgage, you make your monthly payments to the bank and your mortgage goes down. On a reverse mortgage, you receive a check from the bank on a monthly basis, if that's the way it was properly set up for you.
Right.
It varies by individual. What they need, what their needs are, is what you try to actually meet. So the money that comes to them, yeah, it's still your house in both cases. On one, you're watching the mortgage payment go down, the mortgage balance go down. On the other one, the balance is going up, and you don't care because you're not paying on it.
Right.
And as long as you make your maintenance, taxes, and insurance payments, that's your home for life.
Right.
And you have to be able to live in it in order to keep it.
Right, and you could cancel out. You may have, let's say, you might be 70 years of age and have a $100,000, but it's a $450,000 house or something. You could cancel out that and still have, whatever the difference is. It's for 70 years. You get 60% of the balance. So you could still have this annuity
that's where you
coming in and wipe out the old mortgage and not have any payments aside from the taxes, as you were saying.
Right. That's where you get rid of you do a refinance. A reverse mortgage, if there is a mortgage out there, you do a refinance on it. You pay off the existing debt on it, whether it be a first mortgage, a second mortgage, or whatever, any liens, anything else like that, and then the remaining money is paid to the individual depending on the type of program it's fitting into for that individual. To give you an example, I had a gentleman that his wife had passed away. He had the house. He had made a mistake a couple of years ago in taking out a very high-cost mortgage. It wasn't a big one, but it was super high cost-wise for him. And paying about $700 a month in a principal and interest payment. That's in addition to his taxes and insurance. And it was killing him. He says, I got money to pay my other stuff, but I don't have any money for food. What do I do? So we were able to pay off his current mortgage, leave him with some cash, and all he had to do was pay his taxes and insurance. $700 and some odd dollars taken out of his budget and thrown away. He doesn't have to pay on it anymore. He turns around and he says, "You're a godsend. You saved my life." I said, "Gee, thank you." I mean, this is.
And there are a lot of people out there. They're hand to mouth. They're eating peanut butter and jelly and that's what they have at age 75 or 80 because they.
Hey, watch that.
I thought you were 64.
Yeah, you're right, John. Okay, no problem.
Okay, but you know what I'm saying is, and they're trying to get by because they've gone through their, as you say, their annuity, their built-in retirement plan, or there's not much left, and they're really trying to conserve what they got left of the monies that they had put aside, in addition to Social Security. So it's like anything else. You still have the other programs, but this makes it so you can start having maybe some meat once a week or whatever.
One gentleman I spoke to, he was 82 years old. His house was paid for. One of his children was living in Wyoming. The other was living in South Carolina. He says, they told me to come to you for a reverse mortgage. I don't know. I said, what about your income? He goes, oh, I have a very good income from this pension and that pension and that. He was not hurting financially. He says, I want to take out a reverse mortgage. I said, why? You don't need one. You're good financial. You're stable. You're solid. I said, why don't you go visit your son and pick out a house near him, and go visit your daughter, pick out a house near her, sell your house in Danbury, and buy a small house out there and a small house there. Go visit one. When you get tired over there, go visit the other one. He called me back 6 months later. He said, took your advice. How much money do I owe you? I said, nothing. It's free. I mean, this was... Yeah. And it was just a tremendous feeling. You help somebody out, and wonderful.
But it's a good way of consolidating, just like you said, that first example of that guy that's $700 a month. He may have taken a 10-year mortgage, and he figured, I can do it. But then, hey, he was no longer eating any steak. He wasn't eating any chicken. He probably was down to peanut butter and jelly sandwiches or whatever, or bologna sandwiches, and saying, geez, what did I get into? And it's a way of taking the pressure off, right. But still keeping the house.
Right.
And that's important.
And, the other thing is he had no family, and that was, his home was the only thing he had.
And he obviously wanted to keep it.
And this way he was going to have it for his life. Right. Period.
That's an important psychological thing,
Oh.
Yeah. Absolutely. So you got it for your lifetime, and you've minimized. There's other things you can do with a reverse mortgage. You can, let's say you've never vacationed. You can take a portion of the money and use it for that. Let's say you never took long-term care. You could put some of it towards long-term care premium, which is they tend to be expensive, especially if you're 70 plus. But you could do it at age 65 or 68. Plan. Advanced planning, and provide for that, and also provide for your additional monies for your retirement. It's just like cashing out, but not losing the house. You're still living in the house.
Right. That's where the financial planner comes in and gets things set up for you. Correct. Right. That's their position. I don't get into that. It's like I don't practice law.
I know a little bit about that. That's why I brought that up.
Okay.
So I figured I'd... That's another thing you can do in addition to the vacationing or buying a house for your kids, and whatever.
Whatever, yeah. Well, as long as you're financially set, you can throw the money away any way you want.
Yeah.
I mean,
but you've still got your house. If you got the ratios work out, because it's been reformed. It's not a case of, well, isn't that situation where you lose your house at the end or whatever. A very important thing to note is the fact that at the end there still may be some equity, and if there is an heir or there's cousins or whatever, that goes to them. In other words, it doesn't go to the mortgage
under a normal mortgage.
Right.
Correct.
Right, because if you took out $400,000 and there's still another $100,000, the way it was the plan was when it was first came out years and years ago. The mortgage company tended to keep that. Well, under the reformed federal law, that goes back to the family.
Right.
Whatever
people
family
tend to think, and they still think under the old way, if I take out a reverse mortgage, the bank owns my house. Excuse me, if you really want to get technical, every mortgage out there, the bank has a good interest in your home because
they have an interest.
They've loaned you this money on it. So until you've paid it off, quote unquote, they do own the house, and you're paying the mortgage on it, and then it becomes yours when it's paid off.
But if with inflation, as a time goes by and another 20 years goes by, let's say, or whatever, you're 65 and now you're 90 or whatever, and you go to your just reward, as they say, it could be that it's another $100,000 of value, and that's the important point that I want to make, is that doesn't go with the company, and that's what was happening years ago, but it's been reformed.
Correct.
And now the
Thank
family,
God it was reformed.
Yes.
Right.
That's an important reform.
Absolutely. Absolutely, John.
Any other points you'd like to make on the reverse, or is there some other mortgages you'd like to talk about? We've got like 2 minutes to go.
Okay. One of the mortgage programs that were very popular for first-time homebuyers is the state of Connecticut's program. Some lenders won't do it due to the way it's structured. It is very strict. It's called CHFA, Connecticut Housing and Finance Authority. This is a first-time homebuyer program that starts out this week. It's at about 4.5% with 1 point. The normal market is about 4 7/8 with 2 points. They're an FHA insured loan, and they're very generous with the ratios and with the qualifying. And they'll even help out people that are in financial need. They'll help them out with what they call down payment assistance. It's not for everyone, but for the people that can use it to their advantage, I say it's a great thing. So
there's a host of things out there. This misconception that, things have changed, we're back to 20%, or they won't lend you money unless you get at least 10% down and you're making $200,000 a year. All of that is a fallacy.
We're out there to help everybody get a home. The government wants everybody to get into their own home if they can, but they want to do it and keep the home.
And keep the home.
And keep the home.
And there's a lot of programs to keep the existing homes also out there.
Also.
Which a professional can help them out with. Okay.
Absolutely.
All right. Okay. In summary, we've got a minute to go.
Okay.
Sum up if someone had any questions, what will be the telephone number?
The telephone number to give me a call anytime.
If there's any questions about this.
It's 203-778-5900, extension 413.
And there's no charge for questions, general questions. Okay.
All the time, no charge.
Okay.
It's a free consultation. We talk, we go over the whole thing, and it might be a 15-minute consultation. It might be an hour.
Okay. Well, I want to thank you for coming on the show.
My pleasure, John.
You're welcome.
Thank you very much for having me.
And I want to thank the viewers for tuning in to Community Forum. Tune in next week, same time, same station. I'm sure we'll have another interesting program at the time. Good night for now, and we'll see you then.